When do we stop calling this a bear market rally?
Well, maybe right about now, John. And I think the market probably does not move materially higher from here. I think 4,300 will likely continue to be a resistance. But probably the biggest takeaway is that maybe we don't have to retest the lows that we have seen of 3,700. And the reason I say that, I think there is enough that's changed fundamentally to justify that. The reason why we were back at 3,700 is we worried about the Fed depressing valuations, and we worried about the types of cuts that we need to take to the next 12 months of earnings or 2023. And as we look around today, as inflation is easing, it's giving the Fed more wiggle room. So perhaps they don't have to continue to depress those valuations, because even if they hike 100 basis points, Tom, that's already baked in.
Anastasia, the continuum here of the inflation curve is a complete mystery. There's a couple kinks. We don't know where it's going to stop along the way. Maybe it's a glide path to 2-3%, whatever. If inflation in the U.S. and globally comes down more rapidly than the wisdom, what does that do to your stock market call?
Well, I think it props it up significantly. I mean, we were just talking about Home Depot and Walmart, and this would be the types of stock that I would not be bullish on in this environment. However, if inflation does ease up and all of a sudden consumers have more wiggle room in their budgets to spend on things that are not just essentials, then that props up that sector. You know, if inflation eases up and the Fed eases up as a result of it, then we could expect more from technology shares, from the high growth stocks, and so on and so forth. So I think that's a very important dynamic. But I think, Tom, in order for us to materially break above 4,300 and for us to work our way higher, we need to see earnings revisions actually turn the other way around. The reason why I say 4,300 seems to be the cap is because it's based on that $240 of next 12-month earnings and a multiple that's somewhere around 17.5 times. You know, how much more we're willing to pay. Yeah. I think the Fed would probably need to ease up on policy a lot in order for us to justify paying more. And, you know, how much can economy accelerate to justify higher earnings? I don't think that's the outcome right now.
That's exactly where I wanted to go. Do you think that it's too cute to believe that the Fed is going to push back against the essentially easing in financial conditions that we've seen over the past few weeks?
Yes, there's so much talk about that. And first of all, if you look at the easing of the conditions, most of that occurred in equities. And if you look at something like the Goldman Sachs Financial Condition Index, it certainly eased up, but it's still well off where it was just in the beginning of the year. And it's roughly at a 20-year average. So I think, yes, there's been easing on the market, on the margin, but it's not been that significant. The second thing that I would say is I think Fed Chair Powell actually outlined a pretty good reaction function. First of all, he said that they want to be a little bit more cautious as they get to neutral, and we're now close to neutral. They also want to be a little bit more cautious because they know that the tightening that's in the system acts with a lag, and we put a lot of tightening, and he said these words, that there's more tightening in the pipeline. So let's just see how that plays out. And then the third part of this reaction function that he's outlined is if inflation continues to surprise to the upside, we will do more. But if it doesn't, there's probably a case for us to do less. And, you know, to Tom's point, we are chipping away at more and more pieces of the inflation puzzle. So I think against all that, the Fed can actually maybe let the financial conditions ease up a little bit and still do a little bit less going forward.